Econ 4.4, Monetary Policy. Monetary policy is simply the actions by the central bank that determine the size and rate of the growth of the money supply. How do they do that? They do that by affecting interest rates, that is the price to borrow money, affecting spending, savings, and borrowing decisions of consumers, investors, and government, which in turn affects the entire economy, so all components of GDP. Who creates monetary policy? In this country, monetary policy is created by the Federal Reserve, which is the central bank of the United States. The central bank, the Federal Reserve, is headed by a board of governors and a chairman. Currently, the chairman is Ben Bernanke. He serves from 2006 and his term is up in 2014. Here's Mr. Bernanke. When Ben Bernanke retires, the first woman chairman of the Fed, as appointed by the United States President, will be Janet Yellen, who's currently the vice chair of the Board of Governors. The central bank, or the Federal Reserve, where is it? The question is not simply answered. There are 12 central bank locations in the United States, with additionally one in Washington, D.C. that serves as the Board of Governors. So Minneapolis does have a central bank or a Federal Reserve location. And that serves all of District 9, which includes Minnesota, northern Wisconsin, North Dakota, South Dakota, and Montana. Organization of the Federal Reserve. The Federal Reserve is organized by a Board of Governors, a 7-member board that oversees the entire system, as headed by the chairman, which is currently Ben Bernanke. He's known as, he or she is known as the most powerful person in America in a non-elected position. The Board of Governors directly works with the Federal Open Market Committee, which is 5 Federal Reserve Bank presidents serving on this policymaking body. They rotate from year to year, which makes up the Federal Reserve banks. There are 12 of those, which follows by the member banks and other banks that are part of the Federal Reserve system. And, of course, the American people who deposit money in and borrow money from banks. I don't expect you to memorize the Federal Reserve System. However, you should note that the Federal Reserve System is not just one bank. It's made up of various members of various banks all across the country. The supply of money. So the supply, literally, of dollars and cents. The definition of money supply is currency. Currency is coins plus bills plus checking accounts, so everything in your debit account. Money supply is important for price stability. The P stands for price. If we have too much or too great of money supply, we get inflation, and then you'd be rolling your wheelbarrow down to the grocery store to purchase your Mountain Dew and Oreos. If we have too little money, it leads to falling prices and falling production. So the Federal Reserve has a very challenging task of regulating the supply of money, which in turn regulates the economy. The Federal Reserve controls the supply of money through monetary policy. They buy and sell bonds, and they control reserve requirements for banks, and finally they set interest rates. We'll deal with these 3 tools, how the Fed controls money supply, in just a moment. How do we expand the money supply, or how does expanding the money supply work? Well, here's an example. Let's say that you receive 10 $100 bills from your grandparents. They just give you $1,000 on a Sunday. Pretty nice, Grandma and Grandpa. Hope you say thank you. You deposit your $1,000 into a checking account at Elm Bank, because you're not going to go spend all $1,000. Maybe you'll save some of it for later. The bank is required to reserve or keep on hand a certain amount of that money. Let's say, for this case, it's 10% or $100. That makes sure that the bank keeps physical money in its location. Then the bank has $900 left of your money that they can in turn turn around, loan out to make money. So they loan that out to Maria. They keep their 10% reserve, or $100, and they loan the $900 cash to Maria on a Tuesday. Maria takes that $900 and deposits in her checking account at Oak Bank. Oak Bank is again required to keep 10%, so they have to keep $90, which is 10% of $900, and they have $810 left over. So they give $810 to Cody, who spends the money on a new computer. Of course, this isn't a loan. Cody then, after purchasing his computer, Cody's computer store deposits the $810 into their bank called Ash Bank. Ash Bank then keeps their 10% required to keep in the bank, so that way they have cash on hand if for some reason someone comes to withdraw actual cash. They turn around and have $729 to loan out. That $729 is loaned out within the next week to Rashid, who gets a loan for $729. So this expands the money supply without creating new money, simply by allowing banks to have a small amount of money required to keep in their bank and then loan the rest out to other consumers for other purposes. Back to monetary policy. Monetary policy, again, is the changes in the money supply. To reduce unemployment and declining GDP, the Federal Reserve will increase the supply of money. More money is available on the market. To reduce inflation, to reduce inflation, the Federal Reserve will decrease the money supply. There are three tools to change the supply of money, as I discussed before. When the Federal Reserve decides to create an easy money policy or to increase economic growth, they turn on the faucet, which accelerates the growth of the money supply. When they want to have tight or contractionary monetary policy, that is slowing down the growth of the money supply and slowing down the economy, they turn off the faucet, so to speak, and practice tight money policies. So just like fiscal policy, there is contractionary and expansionary. However, they each utilize different tools. Tool number 1, open market operations. Open market operations is when the Federal Reserve buys or sells government securities in the forms of bills or bonds to banks. So these are treasury bonds, most commonly known. So if you have a savings bond, it's somewhat similar to that. You give the government money, and the government gives you the ability to cash that in later for more additional money because there is an interest rate. So open market operations are when the government buys or sells government securities to banks. So basically the government gets a loan from a bank or a consumer. When they buy securities, so when they buy bonds or bills, the bank deposits increase. When the government buys the securities back, they pay the banks cash on hand, which means that the banks will then have more cash on hand. If banks have more cash, that means they have more money to loan to customers. When they have more money to loan to customers, the money supply then increases. When the government decides to tighten the supply of money, they sell securities, which means they take physical money, cash on hand, off the market. Bank deposits decrease because people will purchase those bills or bonds, which in turn means that banks have less money to loan to customers, which decreases the overall supply of money. So the federal government uses open market operations, the buying and selling of government securities, to control the money supply. This is called open market operations. There are two other tools that the government utilizes, specifically the Federal Reserve, in order to control the supply of money and therefore control the economy. Open market operations. What the Fed does to encourage economic growth. They buy government bonds, and that means that banks have more money to loan and interest rates drop because the government buys the bonds from the banks and the banks get cash. The banks have more cash to loan, interest rates get cheaper, borrowing, spending, and demand increase, GDP increases, unemployment rate decreases, inflation rate increases, although slowly. To fight inflation or to slow down the economy, the Fed sells government bonds to banks. Therefore, the banks pay cash, then they have less money to loan, interest rates rise, it gets more expensive to borrow money, borrowing, spending, and demand decrease, which decreases GDP, increases unemployment, and inflation slows down. Open market operations have that effect on the economy. The second tool is that the Fed can change the reserve requirement. So again, the reserve requirement is the minimum percent of bank deposits that banks must keep on reserve to back up their deposits. When you go deposit $1,000 in a bank, chances are the bank keeps around $100 of that cash in the bank and then loans out the rest to other customers requiring loans for cars, new homes, etc. When the Federal Reserve lowers the reserve requirement, so it allows banks to keep less cash on hand, that allows the banks to have more money to loan. When the banks have more money to loan, the money supply increases or expands. Conversely, If they raise the reserve requirement, so let's say that they require all banks to have 20% of their deposits on hand instead of 10%, banks have less money to loan, which means that they'll give out less money and the supply of money decreases or contracts in the economy. These tools are very simple, but they do very complex things in controlling the supply of money and therefore controlling the economy. The Federal Reserve has a third tool available to them, which is adjusting the discount rate. The discount rate is the interest rate that the banks can get from the Fed when they borrow money from the Federal Reserve. Let's say, for example, a bank wanted to increase its prevalence in the community and loan out a lot of money. They would borrow money specifically from the Federal Reserve. The Federal Reserve is also known as the bank's bank. When they do that, they're charged a discount rate or a special interest rate. When the Federal Reserve decreases the discount rates, so it makes it cheaper for the banks to borrow money, banks are encouraged to make more loans. Because when banks borrow more money from the Fed, then banks have more money to loan to the people. That increases the supply of money or expands the supply of money. Conversely, when the Federal Reserve decides to increase the discount rate, banks are discouraged from making loans because banks have less money or it's more expensive for banks to borrow that money. This in turn decreases the supply of money or contracts the supply of money within the economy. These three tools are very important in controlling the supply of money, which also controls the economy. These are monetary policy tools. Similar to fiscal policy, there are very specific tools which expand and contract the economy. Easy money or expansionary monetary policy. Easy money or expansionary monetary policy means that the Federal Reserve could buy government securities, they can lower the discount rate, or they can lower the reserve requirement. They don't have to do all three, they could do all three if they choose to. Conversely, when the Federal Reserve would like to tighten or contract the economy, they participate in contractionary monetary policy, which could include selling government securities, raising the discount rate, and or increasing the reserve requirement. So these are just quick reviews of the tools that we already went through. Here's a great little chart which tells you what the Fed can do if they would like to increase the money supply or decrease the money supply. So if you haven't taken notes up to this point, I suggest you either take a screenshot of this or jot it down. And just a fun little comic to end the video. Frank and Ernest. Hey, my balance hasn't changed. I thought the Fed approved a big increase in the money supply last week. If you don't get it, maybe you should think on this a little bit longer.